Today we have Terence Wong from Azure Capital, CEO and Executive Director, to join us for this live market commentary. All right. So I think without further ado, I'll let Terence to take the mic and start this market commentary proper. Okay. So Terence, the time is yours.
Okay, thanks so much, Ethan. I am just about to power up my screen over here. It's fantastic to be here today. I know a lot of people are probably not exactly in the best of mood because today the market is down 5%. Last week it was 11%, and over the last 2.5 weeks since the end of February, we're down 20%. It is very, very painful. There's a lot of blood. And like what my friend just sent me, he was saying that, hey, Terence, there's like blood all across the street, and a lot of it is mine. I know a lot of us, we feel the same way. It's very, very painful. Since last week, actually, many investors actually reached out to me, and they've been asking me, hey, what should I do in this kind of markets, particularly after the oil issue, and because a lot of my own seminars have been deferred or postponed indefinitely, I thought that, hey, the webinar is really a good way that I can reach out to a lot of fellow investors and can share ideas. I don't know everything, but I do think that we can actually come together as a platform to actually share these very, very exciting ideas. Last week, what happened? I think many people already know. In the US, it was terrible. Dow Jones was down 10%, and many people were likening it to 1987 Black Monday. Anybody that have read my accounts, because I've done a lot of media interviews, and some of it on my personal life, they always ask me, hey, what actually encouraged you or inspire you to enter finance? I always mention 1987 because Black Monday 1987, that year I was doing my PSLE, and at that point in time, many of the parents and all, they will be bugging you to study. But Black Monday came, and it was just a few days before my PSLE. And guess what? My parents were too distracted to ask me to study. So I thought, hey, anything that actually distracts my parents from bugging me to study must be something that's very cool. So I actually read a lot into the stock market, and that really inspired me to enter the industry. And fast forward today, I think that never have we seen the markets slump so badly. And there was and why I have two black swans right here. I know they look very cute, but they are actually very immediate. It is spooking the market. The first one you see over there is, of course, the coronavirus. People didn't expect it, and it was, and people thought that we would contain it very, very well. If you look at the stock market, we first discovered our first case January 17th, and then the markets came off, but it bounced back very, very strongly. There was a lot of excitement because we looked at what happened in SARS many years ago, 17 years ago in 2003, and it was very, very short-lived because by the time we discovered the first case in February, by the time May, the market bounced up very rapidly. So you can see a lot of the stocks were still very, very resistant, but it became global. We were thinking that it's only, I think a lot of people thought it's only an Asian issue, but it became very, very global. Korea, Iran, Italy, and then finally, whole of Europe and the United States got it. And therefore, the market started to slump. That was phase one. Shortly after that, in another Black Swan event, something that we couldn't have imagined, but it is related to the first coronavirus. Because of the coronavirus, there was the demand for oil actually fell off the cliff. So OPEC Plus actually met up, and they were there to actually lower the supply. Everybody was supposed to dumb down the supply, reduce it, right? But guess what? Russia said, I don't want to play ball. And that actually resulted in Saudi Arabia coming up and saying that I'm going to ramp up the supply, I'm going to drive down the prices. And that led to the second round of our market turmoil. And that was very, very painful. That was why our markets last Monday, some people say it is the Black Monday. Our STI actually fell 6%, just following all the problems between Saudi Arabia and Russia. Then, going back to 1987, because it was something that was very vivid in my memory, something that I recall very, very well. That time it was down 508 points in a single day on 19th of October 1987. many people say, hey, but that's chump change. Every day we are seeing over 1,000, 2,000 points change over, and tonight is probably going to be another 1,000 point night. But at that point in time, the markets were no more than 2,000 plus points. So big four equivalent to about 22.6%. But still, the Dow Jones that fell last Thursday, minus 10%, was the most since 1987. That ranks as number 2 in all, in the entire history of trade. STI I mentioned down 11%, and the prices I think are almost unrecognizable. If you were to go into deep sleep 2 weeks ago and woke up today, you realize that many of these, you think that many of these stocks actually went through a stock split. But actually it didn't, because these guys actually slumped. Many of these popular stocks like MM2 is down 55%, High P down 50%. One of the REITs that were listed, Eagle Hospitality Trust, there's a little bit of controversy over it, was also down by half. And they're not alone. Even the STI component stocks, Sembcorp Marine, SATS, Thai Bev, they are all down over 30%. And the circuit breakers were very, very active last week. I don't remember a time where I hear so much about circuit breakers, but it was a galore. US, Japan, India, South Korea, and within Southeast Asia, there was Indonesia, Thailand, the Philippines. Every one of them actually went through a circuit breaker. And look at the stock market. And this, we are talking about not over a course of a year. We are only talking about a course of a month. You know, Dow Jones down 20%, Philippines and across Southeast Asia, we're down anywhere between 12% for KLCI, because KLCI actually slumped, late last month because of the political turmoil. And then all the way up to the Thailand, which was down almost more than a quarter. And many people, of course, we go back to the economy. We want to know whether are we really facing? There are questions regarding the economy, whether is it really a recession right now. I think that the point is really, because to me, when you're locking down countries, and we're not only talking about China, we are locking down the likes of Italy, liberal Western countries like Italy, Spain, France, and good parts of the US and the UK. They're not exactly locked down right now, but then there's a lot of issues happening there, and they're trying to contain it to the best of their ability. Or of course not UK. UK doesn't want to contain anything, but then we're talking about lockdown situation. And even within Singapore, anybody that has that's traveling within Southeast Asia will also be quarantined. So all these things are very, very uncomfortable. Factories are more for, so are airlines, hotels, retail stores. This is unprecedented. If you look back into history, whether in previous crises like the global financial crisis, SARS, Asian financial crisis, at no one point in time were countries locked down. But here we are. We have like made that the economy has like basically grind to a halt. And then imagine, this is not like turning off the tap and then turning on again. That's easy. But the economy, when you want to mothball factories, when you want to like close on shops, it will take a while. In the previous case in SARS, and SARS is very, very contained within the East Asia region. That took 6 months. Even though the virus only came between late February to May, by July we were basically SARS-free. So it's actually a span of 3-4 months. But the SARS, the hit to the economy was more than 6 months. This time around, it's going to be way, way longer. And it's not only going to be hitting the hospitality, aviation, consumer sector, but every facet, every sector out there will be affected. So like I said, I think the economists, it boggles my mind, because they are saying that, it's only going to be, they've been gradually reducing their numbers. I mean, compared to them, at first it was like, I think at the start of the year, they were expecting, economy to sort of like, global economy to like sort of like boom, something like 3%. But when coronavirus set in, they reduced it down to 2.9%. And now, fairly recently, they reduced it down to 2% again. 2% growth, really? I think that they have to, I think a lot of people have to look at the numbers, because to me, it is already a given that there is going to be a global recession. And if you look back at some of the bear markets and recessions, not all bear markets is because of a recession, but many, but you see many of the recession will definitely end up having a bear market. And if you look at the numbers, the average of the recession period, we are talking about from the peak to the trough, the markets, the STI will have fallen an average of between 40 and 50%. In the US, the Dow Jones, I mean the major American indices like the Dow Jones, S&P, that would have fallen by about 30%. Of course, we are always looking for signs of a turnaround, inflection point. The important thing, I think, when it comes to the market, I'm not like spelling out a doomsday scenario, because I feel that there will be a recovery stage as long as we can find, like the infection numbers starting to fall. Actually, and the good news is that China has really shown, despite how serious the condition is out there, they can actually contain this, and they're actually improving by leaps and bounds. They already have a playbook out there. So as Singapore, I think the international community would just need to go with that. And of course, the vaccine is very, very important. Genome has already been mapped out way sooner than what happened in SARS days. SARS, it took them a while, but then this one, I heard that, it's really mapped, early part of this year, and people are just trying to find a vaccine. And I believe that a vaccine will be found. And so the important thing is, while it is tumultuous, there's a lot of volatility, there's a lot of fear in the market. We want to go down to the level where we can define when is a good time to enter. Because as investors, that's what we want to do, right? We want to make money. PE, many people look at PE, but I think that PE is only applicable if you were during good times where the earnings are a lot easier to actually forecast. But in this case, look at it. I mean, I asked you to forecast the earnings of an airline, of a hotel. It is very difficult, and you're most probably going to be wrong. And so I think PE is a weaker form. But during bad times, we will likely want to look at the price to book. Price to book. Actually, if you look at it, it is already hit one of the markers, -2 standard deviation. We are somewhere around there. But I've not indicated the numbers over here. I think a good level to enter is really looking forward 1 year at the book value. And given that at 2020 versus 2019, there will be a fall in the book value because things are crumbling, right? And so I'm estimating a 10% fall in worst case scenario, 10% fall in the book value. And if you look at do a -2 standard deviation, which I believe is going to be the first entry point, we are probably looking at 2,360 points for the STI. And this is the strategy I'll employ. I'm not going to put all my bullets right at a certain stage, right? And it is going to be very similar to the playbook they have done in SARS back many years ago, when I don't have many bullets, right? But I would always put it into different phases. So the first phase, the first part, or the first area that I'll actually go in when the STI hits 2,360, I think that you can invest in some of the quality blue chips. But that said, now there are a lot more options compared to what it was during the SARS days. You can actually also invest in the STI ETF. You don't have to, worry about what stocks to buy. You don't have to worry about the fundamentals. What you can do is, you think that, hey, that's a good level to enter, you can buy some ETF. But don't put all your eggs in at that particular point, because it may go lower. Like in SARS, you think that it's low, but it will go lower. So the next point that I think investors can go into is when it goes to -2.5 standard deviation. You don't have to worry about all the technical terms, but that would be equivalent to 0.8 times price to book, or 2,100 points. That's the next level they can go in at. And then I feel that when fear really sets in and the earnings are super bad, very jialat, then it will go down to minus 3 standard deviation, or 0.7 times book value. If you look across history over the last 12, 13 years, which encompasses the GFC and then the European crisis, and then the small cap implosion between 2013 and 2015, at no point in time have we gone below 0.9 times. But now I'm going to the extreme scenario because these are such extraordinary circumstances that if I apply a 0.7 times book value, we're talking about a value of 1,840 points. Many people, this half a generation who have started to invest will go 1,800 points. They've never seen it go 1,000 plus points. But we have gone there, but we have also recovered. But what if we have used up all our bullets and yet it still goes down? That's perfectly normal. Then we just wait for it to ride up, because I believe the markets will always come back. Let me give you an illustration. This is what happened in SARS, the impact of SARS on the STI. If you were to, let's say, go in at say minus 2, minus 2.5, minus 3 times, actually it didn't go down to minus 3 times standard deviation, but you know, at any point of time, if you were to invest when SARS hit, when the markets do a U-turn, you will still make money, even though the market may have gone down another 5, 6, 7%, right? So you don't have to pick the bottom. I have never been so lucky to be able to pick a bottom. Whether is it the Asia financial crisis, whether is it SARS, whether is it a global financial crisis. Never pick the bottom, but even so, the returns will be very generous as long as you stay invested. So this 4 gives you an opportunity, but I say not right now. Many people also, you know, during bad times will go, hey, but maybe Terence, we can go and invest in some of the safe havens. The REITs have been very, very popular. But I think REITs bear some risk. Why do I say that? Because, you know, the REITs have done extraordinarily well. They have done great over the last few years. Last year, it was up 20% as a group. And that's because many of these, a lot of these guys, you know, they can leverage up. Many of private banks allow their clients to leverage up. So they don't have to put in a lot of money. But by the time the stock or the REIT start to unwind, then they have to start to cough up. And they cannot cough up, they will start to sell. And therefore, you see, even the REITs, which is considered to be safe, which is supposed to be backed by the very strong dividend yields, would see some unwinding when you see like the stock prices coming off. So I think that you can allow some time for it to fizzle before going into one of these, before going to the REITs or the telcos. So many people say that this time is different, and I do admit, I do concede that this time is different. Just like during SARS, that was the first time we actually met up with such a virus, and we were essentially locked down. We at that point in time, we didn't know what to do, so we didn't have a playbook, and therefore it was different. Global financial crisis, never have we seen something so big in 2 or 3 or 4 generations. People have to rewind back to Great Depression to actually see something that's equivalent. So those 2 times are different. This time is also different, but I believe that the results should very well be the same because the markets will return. It is just a matter of how hard, how fast. And during this period of time, I think it gives us a little bit of opportunity because we do have time on our side. I don't think that we can or we should put all our money into the market right now because it is really very unsteady. We don't know the actual impact of how it will affect many of these sectors. And I think that it's going to be worse, or it's going to be a lot worse than what some of the analysts out there are telling us because they don't know themselves. I was an analyst before. We have to basically grapple in the dark. And this is as dark as it gets. So we take this opportunity, go back to fundamentals, we understand the business. Many a times, during the fluffy times, when people start to invest in stocks, they start to chase stocks, they don't know the business well. Now we have the opportunity. Now we can actually look deeper into the businesses, into the financials, and know the management. That's one of the key messages I've been telling investors for the last 20 years. I believe this is one of the most important takeaway. any one of my seminars, I always tell them, you got to understand the management. And that's why in a lot of seminars, I like to invite CEOs, CFOs, the chairman to come down to speak to you guys and allow you to mingle with them and give you a very, very rare opportunity to actually get to know them better. But if you're not able to do that, I also share some of my encounters, my copy ventures with some of the CEOs, and you can come to my Facebook. I also do on investing mode. So I think either or the platform, but I do share a lot of the information about what these guys are like, and you're welcome to go in there and find out more. Okay, and that's all for my formal. Let me see, stop share. That's all that I have for the formal presentation. Welcome any questions that you have. I'm supposed to go up to the Q&A, right?
Yep.
Okay. Okay, question. Do you think that this time will be a V-shape or U-shape recovery? I think that a lot of people are saying that because times are so dreary, right, it will be L. Come down and you're gonna see a protracted way, like you are down all the way, right? But for me, I'm a little bit more optimistic. I think it's gonna be very, very sharp fall. The recovery may not be immediate, like what we saw in SARS, because like I said, everything is at a standstill right now. It takes time for the machines to go back in order, the people to go back to the factories, to the shops, to the hotels to start to work. So it will be a U, but it will not be a protracted, because there's still going to be a lot of the demand for services that, these people that were locked down for months, they will come back with a vengeance. So it won't be a V, neither will be a very protracted U, somewhere in between. Okay. Where to find the STI forward PB standard deviation chart? I get it off the Bloomberg. That's easy. Answer live. I've done this already. Done. Is it time to buy now? I think I just answered the question earlier on, right? Just to reiterate, just in case you missed out the numbers, these are a few numbers that you have to remember. Okay, 2000. It fell down to 2005, and I'm not a technical. I'm not one of those chartists. So you don't ask me to go and draw charts and all these things. I go back more to the fundamentals. And in terms of my preferred way is really to look at the price to book and not price to earnings at this juncture, because these are uncertain times. I go back to the book value at 0.9 times book value, which is around where it is right now. That's -2 standard deviation. We are talking about 2,360. That may be the first entry point. But should you go down further, then we look at -2.5 times standard deviation or 0.8 times book value, and that will give you 2,100 points. And if things are really, really bad, the market is diarrheaing, we're talking about 1,840, and that is based on -3 times standard deviation. Okay, I've done this. The price to book seems to be trending lower despite bull market from 2009 and 2020. Yes, the price to book has gone up, and because we do have, if you look at the STI, we do have a lot of instead of like services or commodities company where the price to book, or telcos are infamous for crazy price to book because they hardly have a book, right? So the price to book is actually fairly high, but we are very, very strong in the banks. The banks traditionally, the price to book is anywhere between 1.1 to 1.3 times. And then you have the property companies. The property companies are even more infamous. Their NAV, they're trading at a discount to NAV, 0.7, 0.8 times PE. And in recent times, we do have a lot of property-related ones like REITs, and that is where it also pushes down the average for the price to book. Done. Okay. We can look at the chat. There's some question. Oh, okay. No, nothing on the chat. Okay, there's a question. It says, what stocks do you recommend investing in? I'm going to take that later on, because I think anybody have any kind of like specific questions on the stocks, I will talk about it. Since it is projected to be worse than the GFC, a 60% drop, what is your opinion of exiting and re-entering the market at a low? I think that right now it is not at a low, so it is not wrong to think like that. Except that we don't know when the reversal will come. I don't. It's just a personal opinion. I don't think that it's going to come anytime soon. So if you want to basically, if you do have a lot of liquid stocks and you think that there's a strategy that you want to employ, I don't think it's altogether wrong, Rachel. But the re-entry point, sometimes when you sell your stock, you want to go in again, you have to have a little bit of determination. Many people will go, "Ayo, I really sold the stock, come off, never mind, I'll just wait." But you set certain targets for yourself. Like I mentioned a few targets that over the STI, but that could work out to be entry points for your stocks. Which sector industry is likely to benefit first? We are talking about generally the front running sectors when it comes to a recovery, the banks, the property companies. These are the front running companies. And don't write off offshore or oil and gas companies, because oil prices have been bashed down significantly. I think that there's a good chance for it's not in the near term, but then when the oil prices recover, I think a lot of these guys will actually recover a lot faster than the oil prices recovery. I want to know your thoughts on Sing Holdings. Sing Holdings is a company that I know well. Sing Holdings, property company, they are very, very conservative. And if you read my Facebook posting with the CEO, I had basically breakfast with him recently. He's a very, very conservative guy, and he actually developed one development. He actually developed one property that was fully sold out, and I think that he's going to get back a lot of money. We're talking about in the region of over $200 million. He owns 70%. He has a 70% stake in that. And guess what? The market cap is only $100+ million, and this project will essentially like boost its RNAV. Its RNAV is somewhere close to, I believe, 90-95 cents. And currently, today, it just got battered down all the way to 34 cents. It will give a good dividend this year. And next year, as it continues to recognize the 100% sales, it will continue to give good dividends. I think it's going to be in the region of about 4 + 5%. Definitely a company that I would trust. Is it okay to nibble a bit into the market now? How about also investing into the US market besides the Singapore market? I think, like I said, I set certain these are not hard and fast rule. If you think that the company they're looking at has already hit, like -2 standard deviation, because that's like more like trough valuation, and you feel comfortable in a company, because if you were to keep a company like that, I cannot tell you for a week, 2 weeks, 3 weeks, because short term, I can't tell. But if it's a good company and you're buying at, very attractive valuations, you wait for 2 years. I'm quite certain that these are going to be this will generate very good returns. Which defensive sectors for now? Okay, the defensive sectors, there are quite a few out there. Of course, the REITs, which I mentioned, these guys are trading anywhere between 4 and 8% yield. The telcos, the 3 telcos are also very popular. Okay, used to be very popular for their dividend yield. They give you anywhere between 5 and 6%. Singtel, a behemoth like Singtel, giving you 6%. Sure, I mean, some of its subsidiaries are not doing great. Optus, the Taiwan, the Philippines, One AIS, they are not doing as well, but Bharti is making a comeback. So I think that companies like that, they are offering fairly decent yields, definitely ones to watch out for. And also, Speaking of defensive sectors, there's also the defense guys. The mother of all defense guys will be ST Engineering. They probably, I think after today's slump, they're giving you a yield of 4.5%. Currently, their order books are at a record high of $16 billion. They just made a big acquisition amounting to, I think, $868 million. I believe that, you know, they're getting their acts together. Orders look good, and I think that that's a very steady play during these uncertain times. Is your fund slowly accumulating on big dips and following an averaging down strategy? Are you waiting for a bottoming out? Like I said, I have to admit to you, I'm not so smart. I don't know when the real bottom is, but like I said, I follow the rules that I just stated. At every level down, I will try to put in some money. With the Fed cutting interest rates, and this is very topical, it's very recent. Fed cutting interest rates, what they just did, and restarted massive QE. Are our banks going to suffer and underperform when the market recovers? Good question. See, when the Fed cuts the rates, you know, and the interest rates will come off, what the banks earn, the NIM, also crimps, becomes smaller, net interest margins, and so they earn less money. And that has been happening for the banks. But the banks have, you know, been generating pretty good dividend yields. A lot of people are lapping it up because they look at the 6% yield that's given by DBS, UOB, and OCBC, and they look through history, the last 25, 30 years, and they realize only like twice, I think it's twice, that UOB gave 6%, and each time it popped up. And there's only once that DBS and OCBC gave a 6% yield. So it is a rare occurrence. But of course, we have to be mindful because of all these Fed cuts, because of the demand pullback in terms of loans. So loan growth will also like slow down, if not go into negative territory. And if they find themselves like not making enough money, I think they will not be paying what they earlier committed to do. So this 6% risk is not definite. So that's something that I think investors have to look out for. Is it time to consider ETF as well? I just answered that earlier on during my presentation. I said that if you are clueless about what stock to buy, you know, look at my levels that I just stated and, you know, buy an STI ETF. That saves you a lot of trouble. Which is the best sector to pick for the rebound? Travel section, SIA, hotel, or banking, or semi-con? Picking which is the best sector out there. Okay, I think that you probably need to look at the entry point also. I mean, you're going to buy right now, let's say SIA, for example. We are at, I keep mentioning trough valuation because that is supposed to be lowest point. And how they find its lowest point? We are not very creative people. We always look towards history for some form of guidance. And it is because I think in the past, it never went below 0.7 or 0.8 times price to book. We use that as a gauge. And therefore, people are saying that, oh, SIA cannot go below $7.50 or $8, whichever your, I mean, different houses will have different guesses. But I think at this point in time, it's a little bit more fluid because you see governments shutting down, and then we have different, and we have like different policies. Singapore just did a slap on, you know, like for ASEAN tourists, and that basically like reduces the demand considerably for the likes of SIA. So these are very different times, and therefore I don't think that we can use the same measure that we did in the past, because what happened in SARS and what happened in the GFC, what happened in the European crisis, are very different from what's happening right now. Right now, we're locking down countries. So if you ask me, like I said, it depends on what entry point you're talking about. If you talk about now, I say, I think you better, like you better look at other sectors to invest in for now. But the bounce up, should it hit a low? I mean, what goes down, if it is not a crap company, will definitely bounce up, right? But I think the time is not to really buy SIA right now. What would be a better sector? Semicon, I don't think is all that shabby because there's real demand coming for semicon. And some of these guys are cashed up. So they're in a very comfortable position. And when the rebound comes, they could be one of the first to experience it. Done. Your opinion on DDS? I think I just answered that earlier on, so I'm gonna like push it to done. Property counters. I think that for property right now, if you look at the demand, obviously it is not going to be great because there's a lot of uncertainty out there. And even though remember there's the on-block craze back in 2017, into the first half of 2018. There's still people that are looking for apartments. It's just that the investors, I don't think that they're anywhere around. So only like selective properties would do well. If you want to buy into property, I don't think that the time to buy is right now, unless, like I mentioned earlier on, these guys are not very leveraged. Companies like Sing Holdings, they have already fully sold off their development and they're very comfortable cash position. I think that these are safer bets in this uncertain environment. But that said, I think that the first to run up when the market improves will be the big blues. And companies like CapitaLand, given that they are very well diversified and they're now trading, I think, about 0.7 times book, that could be something they want to look out for. Like I said, if it hits the levels that I mentioned for STI, that could be good entry levels for CapitaLand, because I believe that they will, or a company like CapitaLand will actually outperform the market. Anonymous attendee. What is the outlook for HR Group for the next 6 to 12 months? Given that share price has fallen to about 45 cents today and P ratio stands at 8.7 times, do you think there is good buying opportunity at this level? HRNet was a company that I had, and I think that it is a very well-run company. It is probably one of the best out there. Many people think that Peter Sim, who's the CEO, the chairman, and the founder of HRNet, is a legend when it comes to HR companies, because I think that he has not lost money since the founding till now, save for 1998. So for 20 over years, this company has been generating cash, and cash, I think, is something that's very interesting about this company. It has $260 million in its coffers. That makes up, I believe, like 40% of its market cap. But these are very challenging times for HRNet, because the two major markets, Singapore, which accounts for 50%, and Hong Kong, Hong Kong has been feeling it for a while right now, but Singapore has not been very healthy also for the last year or so. So, and given that all the problems surrounding, I don't think that there's going to be a lot of jobs out there. So, while it does have strong fundamentals, the financials are pretty much in a good shape, but I feel that this is probably not one of the stocks that will fly, in the recovery stage. Which stocks tend to outperform during bad times? Is it all your traditional defensive stocks? Well, not necessarily. Like I mentioned, during global financial crisis, a lot of the REITs, which is deemed to be defensive, actually started to free fall. And then you can see, can you imagine a company like, say, Capital Mall Trust trading at about 12% yield? And it's because the stock price, I mean, the prices started to free fall. So I don't think that is a given. And if you look at a lot of the telcos, they've not been doing well either. And that's because it is more sector specific. There's going to be another player out there. Competition is very, very keen. So I wouldn't say that immediately. I wouldn't say that it is only the traditional defensive stocks that will outperform during bad times. What is the reason why after 2 rounds of interest cuts and even with the US giving the QE reset of $700 billion, the Dow Jones is still projected to drop by so much? And that's because I think investors feel that the issue is too big. And given how kancheong the US or the US the Fed is in trying to resolve issues through cutting of rates. First they do 50, then they do 100. And in such close succession, that they may feel that it is beyond them to solve it, and they already used up all the ammunition very, very quickly, because what's going to come next? So that's going to be a big question mark, and I feel that many of the investors out there are very, very worried about the economy. What are your views on the oil crisis? When do you think it will recover? How does it impact stock market? Okay, I think the oil crisis, it started by, of course, like you look at OPEC Plus, you say, oh, it's all Russia's fault because they didn't play ball. But Saudi Arabia also like tried to play punk, right? They basically like up the supply tremendously and crashing the prices. I think that this is to every one of OPEC's detriment. If you look across, well, they say, hey, but Saudi very cheap, they go and produce oil at $5 per barrel. That's true. That's way cheaper than the likes of Russia, Kuwait, and all, right? But Saudi Arabia is also giving a lot back to the citizens, and they're using what? The oil money. So actually, oil prices surprisingly have to be $80 in order for them to make any money at all. In order for them not to have any kind of deficit. In Russia, for them to make money, it's $40. So I believe that at some point in time, sanity will set in. And when that does, I believe oil prices will recover. May not be soon, I don't know. I mean, Saudi Arabia refuses to meet again. May not be soon, but it doesn't. I think that it's not something that will last for a long time. Though it is not going to be in the next 1 or 2 weeks, right? It's not going to be immediate. So we're going to see low oil prices for now for the next few weeks and perhaps even for a few months. Who will benefit? People like us, we drive cars, right? So we should be happy. How does it impact the stock market? If like oil prices, I think remain at a good band, it will be good for the economy. But when it crashes down like that, a lot of people will be hurt. There's collateral damage. As you can see, the stock market reacted very violently. STI, when the problem first started over the weekend, the previous weekend, STI in the first session actually fell by 6% from I think 3,001 down to 2,009. How do you see property prices? Is it true that property prices lag stock market prices by 6 months? I'm not too sure about whether it lags stock prices by 6 months, but typically when, in the olden days, when more people were invested in the stock market, not now, liquidity is so dry. I mean, say for this period, but then before that, there's not much liquidity. So I think the relationship is not as strong. But many years ago, when I first started out, a lot of people were investing in stocks. And when they invest in stocks, when the stock prices go up, they feel richer, right? And when they feel richer, they buy assets. So there is a relationship. But I think that this relationship has waned over the years because of the lack of liquidity in the Singapore market. And how do I see property prices? I know a lot of property developers. Many of them are niche to mid-sized property developers. I feel that prices will definitely weaken when we are hitting this recession, because I hold the view that there's going to be a recession. People are going to be out of jobs. The government will have to come in a very, very strong way to try to resuscitate the economy. And that's it. I believe that the property prices will see some weakening. Can you repeat what is the -2 standard deviation range for STI? -2 standard deviation, based on my forecast, I'm looking at 2020 numbers. -2 standard deviation is at 0.9 times price to book, and that would be equivalent to 2,360. Hope you got that. So I see a lot of questions, so I'm trying to see which one is repeated, and I'll try to, or if there's a few questions that's very similar, I'll try to address it immediately, because it's like growing the list, and I think there's another 15 more minutes. I'll try to answer as many questions as possible. You can't, then you just have to reach out to me. This question is fairly similar. If I have lump sum to invest now, how long should I plan to invest in stages? 6 months, 1 year, 2 years? I'm less time based right now because of the, like I said, extraordinary circumstances. So I look more at certain levels of the STI that I believe can give the entry point. This one I've answered about REITs. The spread between Tianjin Zhongxin S and A shares are at an all-time high, with China looking like the first to recover. What are your thoughts on Tianjin Zhongxin? Tianjin Zhongxin does traditional Chinese medicine. The Su Xiao Wan is one of the best-selling in China. I think it's in the national secret kind of category. This stock has traditionally been cheap. It just got a lot cheaper over time. And if you look at the dividends, it's giving you about 5% dividends, which is great. But of course, people are worried about, there's not a lot of transparency between, there's a lot of communication between the management and investors. That's true. But people also celebrate. When you look at the difference between the S and the A shares, the A shares are the ones listed in China. And why I say that is because there's always a very, very big range between the two. The A share is trading about, if I'm not wrong, when I last checked, it was about $2, equivalent of $2.60 Sing. Whereas this guy in Singapore, after being thumbed down, especially today, is at 60 cents. So there's a 4 times difference. Many people are hoping that there's going to be some form of arbitrage, but it's not so easy, not so easily done. Okay, I've done this one. Oil, I can put under done. Is it a good time to buy banks? Done that. Another question on banks. You all love the banks, right? Okay, but there's not certain entry levels for banks, and I think that the likes of UOB as well as OCBC, they've really entered that kind of territory. It's like the bear territory. It's very, very the cheap, the 0.8 times level, right? That is I think like for the 2 smaller banks that we entered there, DBS not yet, but again I think a lot of people are lapping it up because of the strong dividends. Do you think Hong Kong land is safe to accumulate, as unlikely to catch a falling knife? Hong Kong land has like tremendous grade A+ kind of properties in Hong Kong. It's something, and they are also very, very cash rich. Of course, that's before they spent 5 billion, is it renminbi on Shanghai or US? 4 billion US. I heard from my colleague David, who's just standing over there. 4 billion US on Shanghai property. So it's going to be a bit more leveraged up, but it is a well-run company. Unfortunately, for them, the things that have happened in Hong Kong first, the protests, and then followed by the virus that have hit them quite badly. In terms of valuation, I don't invest in the company. I only look at certain metrics, but it does look cheap. I'm not too sure about falling now. It cheap can get cheaper right now. How much percentage of our portfolio is in cash? The answer is not enough. I should have been cashed up a lot more. But before this crisis, and I think many investors do know that I hold about 30% cash. But even so, the 70% can come back to haunt you. How about tech stocks? Tech stocks, I think, will actually benefit when the dust settles. Because like I mentioned earlier on, a lot of the tech counters, they are very they're very cashed up, and they're in far better financial condition compared to, say, like 15, 20 years ago, when they were just like gunning for growth and they were like extending money very rapidly. These guys, particularly the ones in Singapore, it can give you very solid yields, 5, 6, 7%. So these are definitely ones that you want to look out for. Some SG stocks have already been trading at a historical trough PB levels. Good point. During the GFC, while the index has not. Is it safe to buy these stocks? Like I said, I think that you can employ the same strategy. Don't put all your eggs in one basket. If you really believe in accounting, it looks like you do understand a thing or two about these financial metrics. You can put some at -2 standard deviation, which is already cheap. But like I said, in this kind of circumstances, it can get cheaper. Then when it comes off, you buy again. I think when the market recovers, this stock, since you believe so much in it, can make a recovery that is stronger than the market. So I don't know which particular stock you're talking about. Perhaps you can be a little bit more specific. But if it is a quality company, I believe that when they make the U-turn, it should be sharp. Do you think healthcare stocks like Riverstone is worth buying now? I've not looked at, to be fair, I've not looked at Riverstone for many, many moons. I used to be, the research house that covered Riverstone. Of course, there's a lot of excitement because, of what it does, right? Gloves. And gloves are like in high demand. I see Top Glove and all, they're all reporting strong earnings growth as the sector is going up 14%, right? But, everything comes with a price. And if you force the prices, jack it up so far and so fast, then when people start to reassess, they realize a lot of it is because of fluff. And I think that you've got to be very, very careful. Please study the company a lot more deeply and understand the business, and don't buy because of a certain trend right now. What level of percentage loss would you personally be comfortable with when cutting loss? Don't have a hard and fast rule, but because I'm a fundamental guy, sometimes some of the stocks get hit and whacked. It can be down 20, 30%, but it has nothing to do with them. It is more because of the sector or certain rumors. But I always go back to check with the supply chain, not just the management, but the entire supply chain, to see whether there are problems with the company. And if I satisfy myself that it is not a major issue, or it is not an issue at all, they're just rumors, that could be a good entry point. Okay, this one on HRNet seems like a popular one. I've already answered. If my portfolio still has paper gain, wow, you're very lucky, huh? Is letting go the portfolio a better option than holding on in view of the current market sentiment? again, depends on what you're holding. But you think that you're happy with the gains and you believe that you can cash up right now and buy in at a better opportunity. I'm not one that really advises on timing the market, but under such circumstances, I think that it's one of those seekers. You can clearly see that the market is weak. Sure, that there could be big cap bounces, there could be rebounds in the near term, but you can take advantage, of I believe at least in the near to mid-term, it will be coming off because of uncertainty in the economy, because of and therefore I think that there's better opportunity to buy sometime in the future. Okay, property I've already answered. Are you still bullish on Fuyu? No, you know a thing or two about my portfolio. I think that Fuyu over the last few years have really the management. Elson was a factory hand many years ago, back in the 1980s. He started from there. He worked himself up to the C-suite. He first became the COO, then the CEO. So he knows the business very well. It was suffering from overexpansion. So he reduced the factory like methodology. Then he had actually boost the numbers. First, the earnings came because of cost rationalization. But then in recent times, the revenue actually expanded, which was a very good sign. And because he has also reduced the over capacity in China, done all the right things. Of course, with the current situation, I'm not too sure how is it going to pan out. But the good news is that this company has a very strong balance sheet. It has gone up quite significantly and then came back down because of the recent episode. But it's something that I think is worth watching when it goes, like sub 20 cents. Since China is starting to recover, what is the reason why the China REITs are still in the red? For example, Azure REIT, which has dropped from 0.78 times to about 0.65. No, they're talking about 78 cents to about 65 cents now. Well, I think it takes a while for people to there are two things. Sure, China is recovering, and I think that if it's just recovering on its own, and all else, other places are fairly safe, then I think there will be some attention on it. But right now, it's drowned out by all the negativity that's around, and so even with the opening, it will not be newsworthy. That's one, and also because they have lost out for a couple of months. So people are still very wary, and some of them may be waiting for the results to be announced. What do you think of Oxley? They are highly leveraged, but their projects have been selling well. You're right, but leverage only at the most at the surface. I think their loans are to the tune of $2+3 billion. But you look at the pre-sales, they have pre-sold about, I believe, if they were to collect back all the money at once, it would be about $2 billion. They've also sold their project over in Chevron House. They bought it for $660 million. They sold it for $1.04 billion, of which they have to spend another $200 million on AEIs. So I think that they will also rake in about $200 million for that project over a very short period of time. They sold some land in Ireland, and they are going to take back, I think, $400 million. So you add all these things up, the debt is really not an issue. Okay, there's 1 more minute to it, but there's so many questions. Okay, I'm gonna pick one representative question. Okay, some of these have answered, so I'm gonna spend a bit of time just looking at that. Capo. Oh, we didn't touch on Capo. Capo, I think is interesting. I mean, it got hit because of the oil and gas issues, so it got hit pretty hard. But looking ahead, remember back in October 2019, Temasek actually came in to say that, hey, I'm going to offer a partial takeover, 30%. Currently, I want 20%. I want to buy 30% from you at $7.35. So they basically underwrite it. But of course, there's some preconditions to it in terms of the earnings, in terms of they must not have any kind of like major write-downs. So they must satisfy the preconditions. But currently, the stock is trading not high, and I believe that I think it's like $5, and I believe that it is one of the bets that you need. And at these levels, they do have a very credible property arm. So like I said, given that Temasek is coming in, that is something that I believe investors can look at for now. It is I wouldn't say it's a very safe play, but it's relatively safe in the face of this volatility. Okay, I think it's about there. And okay, on FD parity. Okay. I'm reading out some questions out here, right? These questions look fairly similar to what I have over here and what I've answered. But I do hope that, everybody out there, stay safe and invest happily. I know it's been a terrible last 3 weeks or so. It won't, my view is that it won't get better immediately. But there are really opportunities out there. We just have to look at the numbers. We have to look at the business. We look at the numbers, and we do come up with ideas every now and then. And I like to share with the investors out there. So if you can, just pop by into our Facebook. I think just now with my slides, you can see you can see where you can find the information. I tried to do this. I know there's a lot of questions out there I couldn't answer. I really had to apologize. I really couldn't answer all of them. There could be another 20, 30 ones, 30 questions out there. And I really thank you for your support. I try to make this on a regular basis, reaching out to all of you, because in these very trying and challenging times, that's what we need. Share information, and I'm out there. I'll try to reach out to you in my next session, which I don't think is going to be in the distant future, somewhere very close. I'll try to arrange for something maybe on a weekly or fortnightly basis, because things in the market are so fluid right now, and I do hope that I can speak on a more regular basis with all of you. With that, I thank you everybody, and remember, stay safe.
All right, thank you, Terence. Hope everybody had some key takeaways. And Terence spent the last hour, presenting and answering all the questions. Of course, 1 hour it's pretty short. He probably tried his best to answer all the questions. And so do follow your investing note, and he will try to answer all your queries there as well. Okay, everybody, thank you, and have a good night and stay safe during this virus period. All right.